Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good evening. We'll get started in just a minute. I'm trying to navigate downtown Boston traffic as I just got off at South Station, headed home. But I was listening to Spaces, and no offense to those guys, but it wasn't very good. Well, at least not what I consider good. So I texted Mike T, and I said, hey, bud, you think you'd share some of your insights with the nation? And he was absolutely willing to do so. So we'll wait for him to join because tonight it's just a little bit of market chatter. Market chatter with Mike T. So we'll see what happens. Jimmy, how you doing, buddy? Oh boy, got a lot of friendly faces out there. Apparently you guys like these evening sessions, which is great.
Robert, good afternoon,
Hey,
man.
hey, buddy, can I ask a favor? Can you help me co-host while I'm driving, or are you not free?
I'm good. I'm just doing a little jump rope in my garage.
All right, dope.
It's not quite pickup time yet, but happy to just help you man
All
the
right,
ship here.
yeah, just as a backup, that'd be awesome, buddy. I appreciate it.
Totally.
I
How's your
loved
commute?
I loved Chris Moyer's response to your tweet about where'd all the bears go. Are they still alive?
I think I
Maybe.
capitulated 15 minutes to the top today. I started, clearing my book to ease my brain, and then 15 minutes later, we couldn't make 4,200.
Yeah, 417. So zero DTE, baby. They made them print the 417s.
For sure.
Yeah,
My small
yeah.
caps are coming back to life. How
That's
about it?
right. That's right. Ooster, small caps. I know you don't own Carvana, but boy, talk about some deadwood in the water, maybe? I don't know.
These moves to the upside have been wild. I think hopefully Michael will share some of his thoughts about what's happening on the institutional desk and some of the inner dynamics. But it's one thing to look at the daily risk range, but then you look at these different volume nodes, right? That different bears or bulls have been trapped at, and it does seem, just from a casual observation, that like when they take out one lower high or one higher low, it quickly wants to rubber band to the next level. And frankly, when you have names that are down 70, 80, 90%, right, that 50% retracement is vicious. Even something like a firm, right, like the buy now, pay later, that ended the day like $22. That was an $8 stock like a month and a half ago. I think the business is still shit, right? There's so many of those names. Plug back to $18. Like so many of these names. I'll wait.
Yeah, I saw a tweet by Scott Berg, who's an absolute legend. I don't know if he'll be able to join tonight, but he was referencing to the fact that the short covering has been very intense and very aggressive, and when there's no shorts really left out there, what's that going to do to the market when we actually have tough dynamics and basically sellers come in, right? Seller volume comes in. All right, so we got Mike T in the house. Thanks, Jimmy.
Sure, man.
So Mike T, welcome, my friend.
Good morning.
Good morning, good evening, good night. You say
I
good morning to
really, I really want to wait until we have like a lot of listeners before I explain to everyone why this is happening.
Sure.
It took me until Thursday last week to figure it out, and it's actually something I've seen before, but it predates most people's birth. So. And that's really it. But this has been we're way in Six Sigma. We're out there on the curve. I was on the airplane yesterday getting back from Arizona, and this guy's sitting next to me, a real chatty lawyer, smartest guy in the room. He told me so, and And then he said, yeah, I just put 20% of my entire portfolio into Upstart. And you guys, everyone knows that's fucking zero. And
Big
I
old
didn't say a
goose egg,
word.
right?
I didn't say a word. And today at the open, I bought it. It went up. It was up like 25% today. And this is one of the many, 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 many companies that are probably going to go to zero. Like I said on one of my calls, there's more publicly traded companies that are probably going to zero this year than I've ever seen in my life. It is definitely by a mile. And it was just pretty stunning that this guy who's an educated guy is plowing into this crap because he doesn't even know. All he knows is it sounds really crazy and high beta, and I can't miss it. And this is the money that's plowing in. We have to remember that the profile of the investor in the past 3 years has changed dramatically. In the past 3 years, we've had 20 years worth of retail accounts open up, mostly on Robinhood, but others too. And so we have an incredible base of, let's say, lesser experienced individuals who have plowed into this space and into everything, and they are engaged. So that's the excitement, guys.
So yeah, like just along those lines, right? I mean, because it appears that there is a pretty serious disconnect between institutions and in retail, really, at the end of the day, right? And whether it be short dated options and seeing some of those additional buyers from the institutional standpoint on the board while they're trying to hedge their book or trying to manipulate it, whatever. We don't really necessarily have to get into the nuances there, but then you got a bunch of retail piling in on those options, and in combination of those two factors, the dealers are having to adjust and pivot and basically force things higher, right? From the fact that liquidity is low, et cetera, et cetera. So
Yeah.
how are you? What am I missing? Or not missing, but is there anything that you might be able to share, right, with our listeners here about how maybe you're handling this current
Well, I do
new
normally
regime, right? In terms, does that make sense, right, Mike? Like, how are you handling that inside of your book, right?
Well, this is what I did, and I typically do, is that when I see this coming, and this time I didn't, believe it or not. I don't get every trade right. I did
What?
not see this coming.
Are you sure, Mike?
No, it took me about 2 weeks to understand what was going on, and what I do is that I buy calls on my shorts like 20% out of the money, and usually they're not too cheap, or not too expensive rather, and that's how I frequently will save myself. And I started doing that, like, I don't know, probably in 09. So that's usually what
I
I'll
haven't heard
do.
I haven't heard that before. I like that. So 20% out of the money,
Yeah.
and you could use it conversely, right, on puts if anything you're long, right?
No, I usually don't
Or
do my longs
okay,
because they're like, usually when I have longs, they're pretty high conviction.
okay,
So so I'll do that, but also, like, in more normal times, I'll be putting what's called a risk reversal around a short or something. Like if I think it might be a takeout, and what I'll do is I'll sell a put and buy a call around a short to protect myself. Shorting's the hardest part. This is the hardest. This is where you can lose 10% of your book in a week or less, even given this kind of market. And the only way because you don't have the liquid, especially the big books, they don't have the liquidity to actually move and get out. And what I've learned, like, for instance, like Carvana's like almost certainly going to go bankrupt, and it's up. Oh, I don't know what it's up, like 350% this year. And I went out to short it today because I was like, okay, this is enough. This is too much. I'm short some, but I was like, I need to put it back on because I had the calls, and they had expired. My short was taken down with the calls that I had. So my net position is like really small. It's only like 1.5% of my book, and I want to bring it up to 3. And I couldn't get a borrow in it. The thing was up 20%, and I couldn't get a borrow after being up 300%, and I still couldn't get a borrow. So that's part of what's going on here and why it makes it worse. If you recall how it works in these heavily traded shorts, they're changing hands. And when they change hands, it takes 3 days to settle. And so what happens is the short availability goes away until it begins to settle. And I don't mean the stock settling. I mean 3 days, 72 hours to settle, meaning the back office trues it up and now the stocks are in the correct ownership and they can offer them to borrow. So a lot of these things that have moved are actually very, very difficult to borrow, even more difficult to borrow because they've traded hands probably 4 times in the past 36 hours. So it sort of exacerbates the problem.
Yeah, that makes sense.
Well, I mean, it does. Unfortunately, it took me years to figure that out. Like, what the hell? So when I see this, I realize like everyone's in the same camp, and you can't, how many listeners we have now on this thing?
I don't know.
Over 300, Michael.
300 and something. So I think
Oh,
we're good
geez,
to get in. Probably good to get into it.
I know we didn't advertise this one that well. But
No, I mean, I saw you listening to another space, and I was like, I think Mike D and I can do a better job.
Well, I was
so
listening, and
so I
they didn't
texted
understand why this was happening.
you. Right,
So,
right.
I mean, but the positioning was pretty extreme, and part of the reason why I was extreme with the fundamental hedge fund guys is that there's an incredible number of companies that are so screwed, and to the degree I've never seen. They're like, oh my goodness, I have to keep these shorts on because I'm gonna get paid on them. So what are you guys thinking? What are you thinking? I mean, this is really something. Lawyers in the airline are telling me to buy Upstart, and he doesn't even know what they do.
Yeah, Jimmy. Sorry, man. I'm in like traffic. Can you let that? I don't know. Somebody's requested to join. They can come up. It's not a big deal. Mike T. I mean, the economic data continues to come in as absolutely shit, right? So from a fundamental, or not fundamental, from an economic global macro standpoint, the data continues to roll in as quad 4 data, and recession risk rising, and recession risk being the most important to risk manage. So that is how I am positioning it. However, you can't ignore the immediate term impacts that are happening from zero DTE and other just momentum, quote unquote momentum, or however we want to phrase that. But basically, the price action on the board, right? There's to your point, there's lawyers on planes telling you to go buy bullshit beta, and you were in the role as to quote you, my man. Better to make money than to be right. So,
yes, that's right.
Right. So even though the economic data is saying what it is, you also kind of have to position your portfolio and make sure those longs are longer than your shorts right now. Or at least be running
like 50 to 80% longer than your shorts right now, and you might break
right.
even.
Yeah,
So.
I mean, like at least be running net neutral versus like what we had been doing all of 2022, which was running primarily net short, right? And so
yes.
It's the earnings season. It reminds me a little bit of June, to be frank, in regards to earnings coming in.
It is
kind of expectations were kind of muted or had been depressed, and then the market reaction was sort of more euphoric, or at least they caught a bid, but then reality sunk in, right? And to quote Keith, you can't avoid gravity, right? So gravity is eventually going to happen on the horizon, and I think this is where I've been, at least this afternoon, late afternoon, I was layering in a combination of various strikes and various dates in regards to put options, in particular on the Qs, but also IWM and XOK. But also conversely, adding calls to things like GDX and other components like that, which we're long, right? Which we're down, which we're red on the day. So that's kind of how I
Yeah.
was handling it today. But I think it really just depends on your time horizon, my man.
Or actually, it depends on your liquidity horizon, meaning how long can you stay liquid if you're going to dig your heels in. And I know a number of my friends in the hedge book that are running neutral books have had, their worst start to the year ever. So
I can only imagine. Imagine.
I actually I literally can't. I can't imagine if I had a $2 billion book on trying to do this.
Luckily, we're just running our own stuff, right, Mikey? But
yeah.
I mean,
So in my case, it's just 1 billion, so it's manageable.
Yeah, exactly.
But to heaven forbid it was 2.
Yeah.
So how this is going to play out is that when the debt ceiling gets fixed, which will probably, I don't know, they're saying somewhere between May and August, and honestly, who knows? The longer it goes on, the worse of a horrific hangover that we're going to have. And I'll explain to you, all of your listeners now, why this is happening. Well, positioning was one. Everyone can point to that. Japan spending $400 billion in printing press money to hold their yield curve was another. China's $600 billion stimulus here was another. But that wasn't the big one that really sparked it. The big one that really sparked it was the debt ceiling. So about 6 or 8 weeks ago, it was probably, about 6-7 weeks ago, that's when I felt it, and I didn't understand where it was coming from. It was Janet Yellen. Janet Yellen started raiding the pension funds, the federal pension funds, sticking an IOU in there, and then using the money to pay government activity. The federal government this year is going to run around a $1.3 trillion deficit. And so it's around $110 billion a month that they're spending, and in excess of what they're taking in. And the Treasury has to finance this by issuing treasuries in order to pay for it. And she started to stop issuing treasuries and what she called cashing up. And so what's happened now, how it acts, the plumbing of it, is that every month we're getting the equivalent of about $110 billion of fiscal spend dumped onto the economy, with the Treasury not issuing any treasuries to offset it. So it's the equivalent of fiscal stimulus plus quantitative easing. And that quantitative easing comes in the form of that $110 billion, which entirely offsets the quantitative tightening the Fed is doing. So we're net having quantitative easing now, plus $110, $120 billion of monthly fiscal stimulus. And that's why it's acting the way it is. And it's absolutely smothering volatility in bonds, which carried over into equities. Because think about it, you're a pension fund or you're a 401k, whatever it is, you're an allocator, right? And you know that there's going to be 110 to $120 billion of new treasuries coming to market, meaning new as in more than the 31 trillion that's out there. We're going to be adding every month to it. And so they have money coming in, and this is what they're going to buy. But now it's gone. It's not available. You can't buy it. But their money is still coming in. So what do? Well, they got to start buying other stuff. And it doesn't matter what that other stuff is. It's going to smash volatility. And this is exactly what we saw. So until this debt ceiling raises, we're going to have the plumbing of fiscal stimulus and quantitative easing.
Yeah, I mean, vol suppression has been something that I've been calling out on the Weekly Notebook Review for weeks, right? And it's the move just happened, like on the in terms of bond, whatever traditional bond vol, what have you. But that's been very interesting because it keeps getting, it had been north of 112 for quite a while, and then within the last week or so, it's just been absolutely suppressed, along with vol across the board, including FX vol, which has a direct correlation to U.S. dollar. Right, the closer we get to 9 on the vol, typically is when the dollar weakens even more. Now, I think that kind of moved a little higher today at the end of the day, but with that dollar up move. But in general, it's such a good so just to break that down a little bit further, the additional, call it, money flow from the Treasury is just creating more liquidity in the environment and therefore bidding assets.
Well, you're missing $110 to $120 billion of treasuries to buy every month.
Right.
It's no longer there, but the money's there to buy it. And so they have to do something with the money.
Yeah,
and so you just found an incremental buyer to the tune of $120 billion. It's a very large sum, especially given the positioning that we had.
Yeah, and the lack of volume that's been pretty.
So I mean, the equivalent that has happened is that imagine that the Fed has turned its tail on quantitative tightening, gone to quantitative easing, and Biden initiates a $1.3 trillion fiscal stimulus. That's what just happened. That's what it feels like. And here's when it ends, though, we have a gigantic hangover that you can't imagine, where the Fed or the Treasury has to come back to market now with twice the amount of bonds to make up for all the IOUs that she took from the pension funds, the federal pension. Oh, you know who this is, by the way, ringing at my door right now. It's Mike Green.
Is it actually?
Well, it probably is. I ordered some steaks, and Mike Green is over. I didn't even get out of my pajamas today. I just want you to know I was working hard.
Grinding all day long.
I'm walking down the stairs. Okay.
No worries.
So that's what it's going to feel like. Now, the hangover around mid-year, let's say it's mid-year, we're going to have the kind of like a triple whammy hangover where is that the food or is that the green?
It's the green.
All right. Mike Green, we're doing the Twitter Spaces. So we got to a good friend asked me to do this thing. And so I just explained to them how the Treasury is engaged in. Yeah, I didn't get out of my jammies all day. Okay, this is how the real world works at the Starship Taylor. So, okay. So the hangover, the hangover that's going to be a total bed shit is she comes back to market with $260 billion a month of treasuries to sell around mid-year. At the same time, in April, the student loan thing is going to get dinged, and so the student loan reprieve is finally going to come off around at the end of June, and that's going to be 40 million Americans paying an additional $300 a month. That's a car payment. So we're looking at, I think we're looking at in the back half of the year like a disaster, like 3-alarm total disaster. And I'm just wondering when the market's going to figure it out, because it's too far out to buy puts. But so does that you guys get it?
Yeah,
and why this could just drag on? Because it just doesn't stop. It's not about logic. It's about shoveling cash down the throat of the market, and they have no choice.
Yeah. We got a couple hands up, so maybe we'll pass it to the chirp, if you can.
I was wondering. Hi everyone. I just had a quick question.
Like, was this move in the market predictable? Like, or was there like in December late or January mid, was there like signal that came out that said, okay, like this is what the Fed would be doing or Janet Yellen would be doing?
That's a great question. I saw it, but I didn't understand where it was coming from. So, and it took a while. But what I didn't know is that Janet Yellen would start raiding the pension funds early in order to quote unquote cash up, and that's when you saw it start to move. So I'm not so sure it was terribly predictable because we didn't really find out that she was doing this until recently, as in like last week. And we didn't know the degree until like last week.
Is there a way to kind of track that? Is that at all?
Maybe Mike will tell you.
All right.
How do we keep track of how much money is getting raided from the federal pension funds by Yellen?
Oh God, I actually don't know. That's a good question.
Okay, guys, write this down. Mike Green doesn't effing know something. What number am I thinking of? I ask him that, like, what number are you thinking? And like, why do I even do that? He knows it. He knows it. It's 6. See, it's 6.
Taylor, it's February 2nd. It's 2023, and Mike Taylor officially doesn't know something. That's too funny. Trevor, good question,
Green
man.
doesn't know something. I mean,
I'm sorry, Mike Green. Yeah.
Yeah, that's mark your thing.
Iced. So I can't. I'm sorry, man. I'm just driving, so I'm trying to ice something. But yeah, the floor's yours.
Yeah, it's your boy Ice Trader here, contrarian macro strategist. It's great. It's been a great few weeks here. I think this is obviously the start of something pretty big here. I think we've seen just complete bearish sentiment all over this website on unprecedented levels. And it's almost become, nauseating, frankly. These guys coming every single day saying, they're still talking about headlines and the data, but at the end of the day, you have to look at the market structure and positioning. That's how the market is moving here. And you have everyone on one side of the boat here. And we're going. This has fuel. There will be pullbacks along the way. It's a stair-step process, but we'll be heading to all-time highs here in a couple months, if not by mid-year. And then after that, I still see some further upside from there to the S&P potentially going above 6,000 or so. Everyone can disagree. And
So,
go ahead. Go ahead.
Why?
Be very simple. It's not about, the valuation or, the forward multiples, everyone loves to throw out there. It's clearly people are learning that now. This is the end of stage of a 40-year secular bull market. It's the last hurrah. It's a final blow off top. There's a lot of frothiness that's still untapped. There's a lot of sideline cash. This is a secular bull market still. And it's going to be irrational. That's the nature of it.
I don't even understand the words you're saying. I'm sorry. I'm an amateur. Can you talk about, like, where is now? Are you saying that? Well, I don't understand what you're saying. You're using big, broad words that I'm sorry. I'm going to have to disagree, but really just because of the logic. Because you could have also said this last year and the year before and every year that I've been alive.
Well, I'm not. You can look at my feed. You can look at my Twitter feed. I called the June lows and the October retest. It's all there on the feed. Called a lot of the CPI figures there.
This conversation,
it's all there.
But hey, Ice Track, whatever the fuck your name is. This isn't about like trying to get you more subs and all that kind of shit. We're trying to.
No, I'm not selling anything. I don't sell anything.
Market chatter, right? Like, so listen, so tell us some underlying reasons in terms of that helps you in your process to find.
For instance, I can tell you why this is happening and the plumbing behind it and use numbers behind it. I can also tell you that we're going to have lower inflation all the way until about May, and then it's going to stop because the comps get much, much, much harder. So people are also.
I don't disagree. I don't disagree with that.
Okay.
I said it's a blow-off top. It's a blow-off top.
Well, we got a long way to get to a blow-off top.
Yeah.
And all of it has to happen before the debt ceiling comes back, because once we get the debt ceiling fixed, we're going to have an enormous amount of paper coming to market.
I'm projecting a global bust, so the deflationary bust to the likes of which we haven't seen.
I know, but I mean,
post World War II era. But I'm just saying it's not linear. There's one last steep up leg to this market. I don't even like to talk about that bust, a bearish forecast, because it's such a consensus on here, and I don't want to give the bears any more hope than than they've been getting already.
Well, I mean, here's the thing, buddy. We don't do hope, man. We do process.
Well, no, I know, but it's a rhetorical
process,
what I'm talking about, as in these guys.
Well, I think you stumbled on the wrong space, because like everything you're talking about, we're not like, this is not like
this is
bear
not
chatter, man.
We usually have like a lot of facts and understanding.
I'm giving facts.
No, you're
giving
telling
me a single
us
fact. You're giving me this like hopium
nonsense.
It's not any hopium. I'm telling you the facts. You can look at the peak. I call the peak in the 10-year.
I don't give
peak in the 2
years. About what you call.
And we're gonna get to a lot lower. We're gonna go to 2.5% in the 10-year. 2.5% in the 10.
Yeah.
I'm gonna have to ask you to move on to the next speaker, and I really apologize.
Hey, Mike, we don't normally do that, but like, come on, guys. Like, listen, yeah,
absolutely. Mike, would love your input on what do you think about the real estate market, and do you see any potential whammy with commercial debt per se? So I'm a controller in a private equity fund, and what I'm seeing now is that we're having a ton of properties we're basically defaulting on because, or handing the keys over to the bank because we can't get extended on our short-term loans. Would love your input in that area.
I agree entirely. In fact, I see this too. I'm in the process of financing 10 units, 10 properties, and they are dying to get my business. It's been an absolute ghost town. And the reason why I can do it is because they're all unfinanced entirely. They're all cash. And that's why I can get what I'm getting. But they're basically only doing 70% LTV. And I think that the 7.5%, I want to say it's 7.5%. And I am so reticent to take that offer, even though it's probably the best offer out there. And so I understand people that aren't in a more cash-rich position could be in an incredible trouble. So I understand what you're going through. And I cited last year that we're going to probably have a real commercial property problem this year. Now, it's going to be juxtaposed to the next 4 or 5 months of what feels like an awful lot of stimulus coming in, but it's going to be a big head fake.
Oh, absolutely. And I think it's still early on, right? We're just at the beginning of this, right? If they hold the interest rates high for a long period of time, this could cannibalize into something big. I mean, especially in the private equity world where we're buying distressed assets, and holding them for a period of, call it 5 to 7 years. We're taking 70% on the loan of the value of the loan, and if the value comes down, these loans are short term in nature, 3 to 4, I would say 2 to 3 years. And if the value comes down, all of a sudden we can't meet our covenants. And in order to extend, we would have to put down a down payment, a large down payment at that.
I understand exactly what you're saying, because
basically, we're in a scenario where the properties came down, we can't meet the covenants, and all of a sudden we have a decision to make. Do we throw bad money after good money, or do we just let these properties go and hand them back to the bank?
Or the other end is that you
bank to basically negotiate and extend the loan. But we have right now at least 3 to 4 office properties that we can't get them leased because in the markets they're at, and also the work out scenario is making leasing hard. So we're basically, we have 3 to 5 properties right now that we're going to hand over to the bank because we don't know what to do, and we're not going to throw bad money after good money.
But just remember, you're not the only one, all right? And there's a bazillion of you. And so that means that there's going to be a huge bid-ask problem in the very short term, as these, the banks want to get rid of this shit, and everyone's going to be there. So you can probably, things get kind of crazy when it gets like this. So
Absolutely, and I'm surprised that I'm seeing the investors kind of liquidating out of the REITs. Like, I'm not sure if you've seen the news lately of Goldman, not Goldman, sorry, Blackstone, all of the redemptions problem they're having,
yes,
and all of the other REITs around as well.
I cited that coming a year ago, and I'm sad that it's happening, but I think that it's look, they sold these people. I mean, if you read the fine print, it was horrible, but it was pitched as an investment with a 1-year lockup, and after that, you have 100% liquidity. That's exactly how it was pitched to me. But what they didn't tell you is that there's a 3% management fee, and if you want to get out, if many want to get out, you're never getting out, because they gate it. It depends on the product, but it's 2 to 4% or so every quarter, and that's it that can get out. So a lot of people are going to get stuck and start selling other stuff. And that's what we were seeing, by the way, is the beginning
Taylor,
of selling of other stuff.
You were talking about that with me like a year ago.
Yeah, no, I talked about it on a number of programs a year ago. I cited exactly this product because I thought it would be one of the first, because it's jammed to the brim with retail people that don't read the fine print. So, I mean, my broker had been pitching me this for years, and anyway. And this is why I have a broker, because I want to hear this stuff. I want to hear this stuff so I can understand what's going on in the world, ideally before it happens. So,
all right, folks. So I've got about 20 minutes to the house, and I haven't been home since 4 a.m. on Tuesday. So why don't we, Leo? I see you out there, and I know you just came up. So why don't we go to Leo, and then that was a great question. So that more questions like that, and I don't usually kick people off with speakers, but that ICE trader dude, you just need to find a different spaces. We're happy to talk about, to politely debate and review things, right, Mikey T? But you got to have some fucking facts and numbers to back up your conviction.
That fellow that just spoke. That fellow that just spoke was spectacular. That was an exact real world instance of what's going on.
So appreciate it. I don't see your name. I just see a king, I think. A king has, and thank you for that crown, man. All right, Leo, floor's yours, buddy.
Hey, good evening, guys. I had to pour myself a drink after listening to Mike T talk about the bullishness of the market, and then the other guy that was entertaining, at least, right? We gotta go with that.
Yeah.
By the way, that guy was like, well, I picked it perfectly, and these are the trends, and we're going to have a blow off top and blah, blah, blah. And I have absolutely no idea what I'm talking about. Look, I'll be frank with you. I am wearing pajamas, and I'm actually in my wife's basement right now getting some wine. So I could be just the same vagrant that's making pitches.
I had to pour a bourbon, so I figured.
I heard a little ice clinking in my greens glass over there. So
he's up. Anyway. He's chatting up my wife right now. They're on the couch. She's not wearing much. I'm just setting the table for you.
So how does this not bring?
Let's get to your question.
Right on. Yeah. So how does this not bring back inflation roaring back the next couple months if we are stimulating the economy this month?
It's not terribly inflationary. It just drives assets up because it's not new fiscal spending. It's new fiscal spending without, or it's being delayed. I mean, think of it like the student loan thing. It's like that, where, you have the debt, but you don't have to pay it back yet, or any of it back yet. And that's what we're engaged in. And so this is the reaction. It's not inflationary, but it will inflate assets.
And the only thing it's really going to inflate is assets, though. So it's not going to help the economy at all. So when companies come out with their numbers, like Canadian Goose today, and they were atrocious, that's when you get your headline risk. Is that kind of what you're thinking? And then you just kind of trade around that?
My view is that the discount is lowering. It's going to accelerate to the downside as everyone gets fooled into a lower inflation, and that the Fed will pivot. But after about May, that'll be it, and then we're kind of stuck. And then right as we get to June, the student loans come back, the debt ceiling gets fixed, and then twice the amount of debt comes to market every month for the remainder of the year. And that, I think, will drill this market into a total world of shit.
All right. Thank you very much.
So there it is.
I love that.
Cats. Oh, she's yelling at Mike Green. Get off of me, you.
Oh, man. All right, so we got a couple of hands raised. I don't know, Jimmy or Mikey T. I don't know if you see any of them.
Hey, Mike,
just
I have a question.
A couple questions. Then I got.
All right, yeah, we got time for like probably three more questions. So the three that we got hand raised, and we'll call it a night.
Yeah, just really quick. What's your view on pharma and managed care? They've been beneficiary of the defensive trade, and there's some rotation out of that today with some fundamental news. Yeah.
Violent rotation. You have an enormous amount of investors that are in the space that don't really know what they own or why, and so that's a big danger. That's a big danger. So I am at the margin bearish on pharma, and HMOs and med tech are probably going to outperform, certainly over time. So does that help?
Yeah, thank you.
Yeah, awesome. I don't know who that was, but I go with KCLF something.
Yep. Thanks for letting me ask the question. Appreciate you guys putting the space together. So my question is, obviously this isn't the first time that we've approached the debt ceiling or had this kind of.
Casey, you with us?
You hear me?
Yes, I can. I'm sorry.
We're good.
Hitting on my wife quite heavily at this point.
So my question is, obviously this isn't the first time that we've encountered this where we're approaching the debt ceiling or hit the debt ceiling.
Hit the debt ceiling, yeah.
And I'm sure we've had to do these extraordinary measures before. Are we able to see the effect on the charts looking back historically, or was there just too much QE going on in general where it would be kind of like muted?
Well, usually it's short. A debt ceiling debacle, it's very short, and you really don't see the extraordinary measures. But this time, it's going to be long, and so you're really going to see it.
Got it. Okay. I was just wondering if it was possible to back test or something, but yeah, appreciate you answering the question.
I'm sorry. My phone was ringing. Do we have one more question?
You're good. No, he was just asking about back testing.
Oh, back testing. Yeah, I don't think it's very good because we haven't had a debt ceiling that lasts for 6 to 8 months.
Yeah.
And remember, we need to be running a gigantic deficit at the time for it to actually feel it. You need a lot of new debt that would be coming to market that is no longer coming to market. And that way you can feel it.
Yeah, we got a really good policy team at Hedgeye, just FYI, that is very plugged into everything that's going on at the Hill and, and surrounding the debt ceiling and what's transpiring there on that side as well. So if anybody's interested, reach out to sales@hedgeye.com. Future something or other. Sorry, man. I'm just on 95 north going 75 miles an hour. So sorry, guys, for not being able to call out your names better. But floor is yours, future.
Awesome. Thanks, Robert. Yeah. Hey, Michael. Nice to talk to you. I had one brief question and just a quick follow-up, so I'll keep it quick.
Okay.
The first question is, are there any sectors or mega caps that you think could benefit from sort of self-help? And I guess what I mean by that is, if you just remove the macro a little bit, names like, as recently as yesterday, Meta, maybe Netflix, and others in the recent past have sort of benefited from self-help. And just wondering if you see any sectors or particular names in mega cap that might be good candidates. And just one follow-up. Thanks.
I don't understand what self-help means. I'm sorry. But I will say, as to the move that you've seen in the mega cap tech, that's largely positioning where we've been. You look at the data, look at the numbers. Holy crap! You want to be defensive, but then a buyer that you didn't see coming, namely the lack of selling by the Treasury, has forced them to rejigger their book in the most abrupt fashion I think I've ever seen since '09.
Understood. Yeah, and the sell-off in commodities was pretty insane today too. My follow-up question was, do you use any technicals to sort of complement the macro work that you do? Either I know we're not supposed to talk about moving averages, but moving average, Elliott wave, kind of anything else you use to complement your analysis?
The technical analysis doesn't work as well as it used to. Meaning 15 years ago, because there's far fewer humans than there were. And, these technicals were really, all of these technicals were, let's say, founded in emotion. And that's how all the sort of the history of technicals came about. You could actually plot emotion. And now there's about 43% of the money managed is by humans, and the rest are passive or machines, and so it's not very useful. I mean, I use it, but in the broadest strokes, do I use it? So, and it would be really simple, honestly. One thing I look
I've
at.
seen you share some like Fibonacci stuff, right, Mike?
Oh yeah. I'll do Fibonacci's, especially for the next level when it's going to move. That tends to do it. It's either moving averages and Fibonacci's, and they tend to find their way there, and I don't know why. And so I keep using that. So it must mean that some quants out there are using Fibonacci's too. But I tend to use a lot of, like, somebody just asked me where Amazon will go, and I was like 126. 126 is the next Fibonacci. That's where it'll go. It would also break out above the 200 DMA because it kissed it today and kind of failed there. But the next move, if it does lift, will be 126. And that's just from memory on the Fibonacci. Someone can correct me if I'm wrong. But that was my next Fibonacci level.
Sure, thanks.
As an example of a company that's reporting tonight.
Yeah, future investors, just like spinning around, is there anything that you have found helpful in your analysis at all? Do you use TA much?
Yeah, I mean, I guess just, high level background. I'm, sort of deeply fundamental, and was trained that way. And, I just started to notice over time that like my best trades have trended. And so when I went back and, I use back testing in air quotes because I'm not a quant, but when I went back and back tested, like, I mean, I basically noticed that they'll break out of a significant moving average, and then we'll typically surf one of the upsloping moving averages. You got to be over the 200, but principally like 50, 20, or 10. I know there's some big macro guys that still use them. Like I went to this like a master class actually with Paul Tudor Jones a few months ago, and it sounds like he still uses like the 200 day and the 25. Interestingly, Mike he actually also recommended that people read the Elliott Wave Theorist, and Elliott Wave relies heavily on Fibonacci's for price targets.
Oh, very good. Guys, I'm getting called away.
No worries.
Oh, one more question.
I'm going to have another child. I left Michael with Jill for too long.
No worries. Hey, Mike, thanks, buddy. Thanks for jumping on,
Okay,
man.
guys.
And we'll do it again soon, okay?
Down left. Okay.
All right.
Be good,
See ya.
guys. Good luck trading.
All right. Cheers.
Oh yeah, sorry, I didn't mean to hijack the rest of the space, but just high level.
Well,
yeah.
Hey, one thing on the Paul Tudor Jones thing. Have you ever seen the documentary on him? He was a total Elliott Wave guy in the 80s.
I have, and that's why I was so kind of amazing to hear him reference it in modern day. Like, it's actually interesting. He said that, so like he was famous for, I think that Elliott Wave theorists, like the guy who runs it, Bob Prechter, tends to be I don't know if he's a perma bear, but he tends to lean bearish. And so he had called the 1987 crash based on the end of a wave sequence. And, Paul had used that. I think like 87 was his best year
Yeah,
ever.
yeah.
And so he said after that, though, he, his words, not mine, but he said after that, he had to start fading Elliott Wave because like everybody was copying his
Yeah, it
trades
got
and
crowded.
everybody was using the newsletter. So he kind of started like counter trading Elliott Wave for a while.
There's a famous story
Yeah.
about the weekend before that Monday, Black Monday, that I think it was the head of Dreyfus Funds talked to Paul Tudor Jones, who basically said it's all over. And then he knew Stanley Druckenmiller, and Stanley Druckenmiller was totally long. And basically that Monday morning, he went in and went totally short and completely changed his thesis. It's like a famous story about what a brilliant guy Druck is, but also what a brilliant guy Paul Tudor Jones is.
Yeah. I hadn't heard that story before. And is this wild something? Sorry, is that who was talking? What was the doc? Where was the documentary?
It's a famous doc. If you just Google Paul Tudor Jones, and it's shot right in 1987, like a month before the actual crash. But the thing I was going to ask Mike about was. Well, the one thing that happened with BREIT is that I don't know if you guys saw, but right when the what was going to hit the fan, University of California came in with a $4 billion investment, which kind of shored things up a bit, which is cool.
About 2 weeks ago.
Yeah. But I just wanted to see, did he say anything about any contagion with this Adani fallout? Because I saw like Apollo went in and they had a huge investment very, very recently, and I'm just wondering if anyone has any thoughts on that.
He did not speak about Adani, and I don't know enough about Adani to comment. So if anybody, we can crowdsource this bad boy, which is the beauty of spaces.
Yeah.
But so if anybody's got any commentary on that, by all means, you can jump up or whatever.
I'll pin Michael Taylor's tweet on it.
Cool. I mean, we clearly know there's a blow off top coming around 6,000 soon.
Blow off top for the ages.
Ages. I'm a big fan of the Hedgeye world, and Mike had an awesome interview with Keith, I think, or earlier this year or late last year. It was great. Really loved it.
Beginning of June. Awesome, man. No, I appreciate that. That's great to hear. We got another question. 2 questions. We can probably take both of them. Sorry, is it Muhammad Monday?
Yeah, thank you. I appreciate the opportunity to ask a question. I don't know. I kind of arrived a little bit late, so he might have already talked about it. But I was just questioning the falling RRP because I feel like the same situation has been in place where the Fed is offering overnight rates that are higher than maybe the 3-month bill, and so this liquidity, obviously, Treasury generated liquidity injection, the extent of which, I guess, that's the other question I had, is how much force he thought that played, because some of the other things that I'm seeing in the background that have been talked about, like N2 falling below 0, falling commercial loans. So a lot of money, cash, in the falling savings rate. So a lot of cash isn't with retail. So how much of this are these commercial institutions doing the buying right now, and what the extent of that is in the backdrop of the money market funds still offering, or Fed overnight facilities still offering funds returns higher than MMFs possibly. And so that was one of my questions. And the second one was there was a recent FT article I read that said 25% of these loans that are coming up to maturity are healthcare related, and the industry is facing significant amount of downgrades. And so it is this buying, is this more kind of indiscriminate, or are we going to see certain parts of the fixed income market be kind of their credit spreads kind of widen more than others, or is this kind of pretty much indiscriminate until like he said, kind of the debt ceiling and some of these other things happen over the summer.
Yeah, you got in. Sorry,
Yeah,
yeah,
I'm not gonna speak for Michael, but
exactly. Yeah.
some of this treasury stuff. We love talking about similar sets. So I think it's been a few weeks now. We've talked on Hedgeye. Just first since October, you just had the dollar with the blow off mega top. It's fallen, and the fact that it hasn't even gotten close to the middle of the range, it's just kept on going down. That was one thing. You saw Bitcoin fool around as early as 4 to 6 weeks ago, and there was a bullish divergence there. And I was discounting it, I was short it, but there were signs. And then we saw China turn bullish and hold bullish into the new year. So I'm not sure where this risk on flavors coming from. It's a little bit of everything, I suppose. But I'm still inclined to believe that it's a vicious bear market rally.
Yeah, Mohammed, the M2 money supply, you can't ignore it, right? So whether it's coming, just, whether it's M2 or to piggyback off of Mike Taylor's commentary, which again, that's something that he's seeing. I haven't done the due diligence yet to review that. So I'm not going to speak to that component of the liquidity, or the basically liquidity that's kind of in the market right now. I think it makes a ton of sense from a theoretical standpoint, but I need to go do more due diligence on that aspect, right? But in terms of what you should be tracking kind of regularly, the M2 is obviously key, and the money supply, and then the volume and the liquidity inside of the market. And I think those are really big components that are impacting what's transpiring out there right now.
Yeah, I appreciate it. Yeah, it was interesting because Jay Powell, he was mentioning that liquidity is significantly restricted over the last year, and then I know a lot of people were sharing I think it was J.P. Morgan's chart where liquidity was, or at least over the past month or so, was kind of declining. So it was interesting that definitions were kind of they were in contradiction, but like you said, I mean, price is truth. So.
Yeah, exactly. Thank you, sir. Sorry, I was just filling up the gas tank. I've got time for one more question. I think was it Hard Weldon?
Yes, sir. Thank you.
Lord
Yes, sir.
Scrory?
Thank you so much for taking my question.
Yeah, absolutely, buddy. That's a great name, Lord Scrory.
Oh, yes.
I like
Thank
that.
you so much. My name is Alan. I just want to be professional.
Cheers,
hey, thank
Alan.
you for taking my question. Hey, real briefly, could you guys touch on Silvergate? I understand that I don't know what exactly happened. I've been kind of pruning and planning on this stock, and obviously this is from Coyotes and stuff like that. But from your knowledge, could you briefly just touch on it? Thank you.
Hey, Hamanov, are you in SI at all?
I can help if you need to.
Oh, let's go, Leo. Yeah. I just know it's a fraud. I don't know. Like,
Yeah, no, it's a zero, right? But
it's a zero.
Obviously, it's squeezed higher today, basically on news that it's in the ETFs of BlackRock, and I'm sure it'll be. So that's what squeezed it higher today. But then the news came out today that they're being investigated by the SEC for wrongdoings. So that put obviously a pretty nasty sell into it this evening. Hopefully, because I am short of it.
So no buys there.
Right, exactly. At the close, it was ugly enough where I almost thought about adding again because it just kind of felt a little bit eerie. But I didn't even know if I could get a borrow at that point. Yeah, I didn't. It looks like it's down pretty good after hours, but it's very interesting. Just like when you read like people's quotes of why they're borrowing it, to moon it or this or that, and all I'm looking at is what their past price was, right? And if I can get it for $15 instead of $250, it's what a deal, right? If I can get Carvana for $6 instead of $350, who cares if it goes to zero next week? Like, it's just I got a chance to moon it, right? So that's that. I think that's the driver behind all these shit goes. I don't have to tell you guys that. I'm sorry, but it's pretty amusing stuff.
Thank you so much. Thank you to everybody for what you guys do for the community. I was in Miami, and I highly appreciate it. I got a lot of knowledge for it as a young man. So thank you so much.
Awesome, Alan. Yeah. So what I'd say there too, Alan, just from a risk management standpoint, is SI and Carvan. I mean, they're crowded shorts, right? So you got to look at that short interest, and high short interest works well as a factor exposure, typically in quad fours. But when it starts to move and that momentum, basically, there's a slide in our deck every week on the macro, sorry, every day in the macro show. It's the factor exposure, and you can track this on your own. But it's the high short interest, right? So when stuff with high short interest starts to pick up momentum, it forces some short covering. And you just have to be conscientious as to like what you're shorting and who you're kind of getting into bed with, right? So like a crowded short, you're going to need to be more active in regards to risk managing that position. If that's not part of how you invest or trade, then you need to kind of, I would recommend that you kind of pivot a little bit in terms of where you're putting on your shorts, right? And sort of the exposure or the inventory that you're using to express that short in Bitcoin. So that would be kind of like my 2 cents here in regards to Silvergate, because it's really important to kind of risk manage the positions, especially with volatility here, as Mike and I were talking about earlier, that's being suppressed, right? So lower volatility, that we call that the chop bucket, and when you're in the chop, it can really chop you up, and so you got to be a bit more active, especially in your short book and your short positions, and so being more active and being conscientious as to where your position sizing is, and just managing that position, risk managing it, and feeling comfortable, going down to zero in terms of like the position size, and just being like, cool, that was an awesome 5% trade or 2% trade down or 20%, like gain, or maybe it's an 8% loss, and you're like, fuck, I missed that, I fucked up my timing, but here's my stop loss, I'm out, and I'm just going to reassess. There's a lot of inventory out there. So I would just kind of say that, SI is obviously a very popular one, and every time I put in SI for silver, everyone's like, that's Silvergate. I get it. But like SI is also the commodity, the futures commodity for silver. And I don't trade Silvergate, but I do trade silver. So hopefully that helps. And again, I'm not trying to be preachy or anything. I'm just, the risk management is a really big piece of the game, and helps to, be able to play tomorrow.
Thank you so much.
Awesome. You got it, man. And thanks were you at the regional?
Yes, sir, I was.
I
I definitely like
awesome.
to say I was easily the youngest man there. Easily.
That's awesome. That's awesome, buddy. Well done. Thank you for joining us. And that's amazing. So keep it up, and reach out anytime. We appreciate your support and all that kind of stuff. So with that, listen, guys, I just pulled into my driveway and excited to go see my wife for the first time in a few days. And but I'll catch everybody tomorrow. We got a big beginner's guide at 11:30. And for those that might not be familiar with our thing here at Hedgeye, we do a weekly notebook review, Twitter Spaces every Wednesday afternoon at 4:30 post market close. Hopefully we can see y'all then. But with that, I hope everyone has a great night. And thanks for hosting, Jimmy. That was really helpful.
Yeah, no problem, Robert. We'll see you tomorrow. And 75 on the 95, those are rookie numbers. So you got to step that up. All right.
You calling me out? I was trying to be
more beta.
Yeah, risk tolerance, right? Risk tolerance when you're on your phone trying to handle the spaces. Anyway, awesome, guys. Have a good night, everyone.